Howdy, Jacob here. Today we'll be looking at the next company, our dividend yield screener, ticker symbol CHT. Let's start looking at some financials. So we have a 29.2 billion market cap with a 28.8 billion enterprise value. So low net debt, which we like to see. Um, Return on assets, return on equity, return on invested capital, all very consistent. Looks like it's been falling, which is the opposite of what you want to see in the last 15 years. Been mid-teens down to high single digit, which is fine. You always want it to be higher in your weighted average cost of capital, so then you're adding business rather than just having to consume money to add business. But look at revenues. I mean, this is slightly declining, really just flat as could be. They're a diversified telecommunications services company. Honestly, kind of surprising that their debt is so low since this industry is like AT&T, Verizon stuff just have gallons of debt on their balance sheet. But yeah, so this is fairly impressive to have only $1 billion in long-term debt. Um, so this is a company that's been making money for a while, very consistently. Cash from operations, 2.1, or it looks like 2.03 billion is their lowest in the last 10 years, and then 2.698 is their highest. So, and I mean, what their property, plant, equipment they're using to sustain the business is also fairly consistent. Um, so that's good. Looks like their dividends is essentially everything that they do with their payout. Um, so I think we can just get right into it. Start making some assumptions here. I mean, I don't know this company well enough to know if they have a moat or anything. If they did, I might increase their terminal P and um, terminal free cash flow. But with what I know right now, I think this is one of those companies where I'm just going to say there's no growth, 10 PE, because there's no, I don't see any mode status going on, and it doesn't look like the business is going nowhere. But it doesn't look like they're going to be thriving, especially with their payout being almost 100% just straight to dividends and no other forms of reinvestment. Um, but it is a very consistent company, so there might be worth to companies where you just know what's going to happen. So I'll give them just a tiny baby bump in terminal P and cash flow, just because I think if I'm an investor, or just a regular old investor, I love consistency, and you can see here that they are extremely consistent with their earnings. Looks like again last 10 years, $1.40 earnings per share, $1.80. I mean it's very consistent, and investors love that. So I think for here, like that cash flow's higher. Let's do 17 and 19 share change. Yeah, that's not right. Um, so let's do share change of 0%. Their shares really haven't changed whatsoever. It's 776 million outstanding. So all right, and then $1.48, $1.48. I mean they're a flat business, so I can't really say they're going to increase it. Um, we can keep it the same for now. So all right, so this looks way lower. So we're saying it'd have to fall 66% to get to a 15% yield. Given these assumptions, I think right now I'm definitely waiting. I mean, this is a company that's not growing, so I don't know where I could beef these assumptions up to where it makes sense, but it's never what you want to be doing. You want to what you think is most likely going to happen with some conservatism. And right now, I think that it's a bit overblown, and I'd be waiting if I even did want to add this to my dividend portfolio if I wanted that excess cash flow month over month. So, all right. I hope everyone has a good rest of their day. Thanks so much.